I'm Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this latest market report.
Hey, Tom.
Yeah.
You pull your microphone a little bit closer.
Oh, sorry. Yeah, we're having a little technological issue this morning, so I really apologize for getting late this morning, or getting started late. But we got it up and running just a couple minutes late, so hopefully it doesn't inconvenience too many of you. But for those of you who are unfamiliar with our show, I'm Tom Boley, Chief Market Strategist here at Earnings Beat. So really good to be with you here on this Tuesday, November 5th. It is election day, so please get out and vote. Yeah, I mean, I'm looking at the futures. Futures look pretty good this morning. I'll give you the latest here. Bear with me one second. So right now we've got the diamonds, which track the Dow Jones up just under 0.1%. So nothing really big there. S&P 500 futures are up about 0.1%. The NASDAQ 100 looking to open up about between 1 and 0.2%. And small cap IWM down 0.1% this morning. So really nothing big. This is the biggest week of earnings, though, in terms of the number of companies reporting. So most of the big companies, the Mag 7, most of those companies have all reported. Many of the Dow components already reported. S&P 500 after this week, the lion's share of the S&P 500 will have reported as well. So this will be pretty big in terms of not only these earnings reports that are coming out, but then also we have a Fed meeting that starts on Wednesday. Because the election is on Tuesday, this is kind of an unusual situation where the Fed meeting has been pushed back a day. So it begins tomorrow with the Fed announcement out on Thursday. And it's widely expected that the Fed will cut another quarter basis point, adding to the half of a basis point that was cut back a little over a month ago. So anyway, I think the market continues to take things mostly in stride. I mean, I've got it's definitely a confusing market because I've seen some mixed signals. I long term, I'm still very bullish. I remain bullish. I've remained bullish for 11 years, almost 12 years. And I don't see anything to change the long-term picture at this moment in time. Many of the inflation numbers that we like to follow have been coming down. That's allowed the Fed to cut rates to bring them back down. Remember, the only reason the rates went up was because of inflation. And so the Fed was using their tool to raise rates to try and rein in inflation. So they left the rates up for quite a while, much higher than they needed to be based on our economy. But it was simply to try to stop inflation in its tracks. They waited until inflation, in their view, had moved sustainably toward their 2% target. Now, keep in mind, we've talked about this over the last couple of years. It seemed like a moving target as far as what sustainability meant. But Fed got to the point where they were comfortable. They said they were shifting their focus about a month ago, maybe a month and a half ago. And as a result, they turned from raising rates or leaving rates higher for longer, and they cut rates by a surprising 50 basis points. I thought it would be 25. I think it was kind of mixed in the market as to whether you thought it would be 25 or 50. They did have a dissenting vote, which was the first time they've seen that in a while. There was one voting member of the Fed that thought it should only be 25 basis points. So there was some dissent for the first time, but they did cut rates nonetheless. And we seem to now be moving into a rate cutting period. And that's why I believe we're going to see another quarter basis point cut coming up this week. The 10-year Treasury yield, however, continues to move higher. And this is what's confusing a lot of folks. They're wondering why is the 10-year Treasury yield, Treasury yields going up if we're going to cut rates? That doesn't make any sense. Why is the 10-year yield going up? Well, the Fed only controls short-term rates. The Fed controls the Fed funds rate, which is essentially what banks can borrow overnight from the Fed or from other banks. So that's, when you want to trigger economic growth, you start making it easier for the banks. Or if you want to be more restrictive, then you start raising rates and make it more restrictive for banks. And that kind of controls the capital liquidity. And so as rates go down, as short-term rates go down, this is what the Fed controls. It becomes easier, for instance, for small banks that rely on borrowing. All of a sudden, if you're borrowing at 4% instead of 5% or 3% instead of 5%, makes a big difference in terms of your spread, because that's the interest that they're paying. The interest that they're receiving are from the loans. And if the loans, which is more based on the 10-year rate, well, the 10-year rate's going up. So what we're seeing potentially for the banks, which is why I'm such a big fan of the small and regional banks, is that you're seeing a lowering of that Fed funds rate. So it's making it cheaper for small and mid-sized banks to borrow. And at the same time, the 10-year treasury is going up, which is more, that influences the long-term rates like you'd get on a mortgage. So it's kind of nirvana for the small banks, mid-sized banks, which is why I believe the banks are going to do well. And yesterday wasn't a great day for them, but overall, the banks have been doing pretty well over the last few months. And in turn, that should lead to the availability of capital for many small and mid-sized companies that didn't have that access when rates were higher and the Fed was keeping them up there. So that's one of the big differences as we move forward, is that what the Fed's trying to orchestrate is what's called a soft landing, where you fight inflation, higher interest rates are having a negative impact on the economy, yet the economy remains resilient enough to handle those higher rates for a while until you squash out inflation, and then you start bringing those rates back down to spur the economy. And so in doing that, they're hoping that we avoid a recession, even if it's just slow growth, mild growth. And the way the market's been trading, the stock market's been trading, it looks as though they believe the Fed's getting it right and that the economy is going to strengthen later, probably not in 2024, but maybe in 2025. And if you get a strengthening economy with inflation back down to target 2% level and short-term rates coming down, that's nirvana for equities. That's absolute nirvana. So anyway, that's kind of where we sit right now. And, we'll just continue to monitor it. But let's go ahead and take a look at what happened yesterday. So I'm just going to zero in here on this market overview at stock charts today. And you can see we had some red, some green. Small caps did well. The larger caps did a little bit more poorly, but nothing really, we're mostly between a 0.5% gain, a 0.5% loss across across the board. The one thing, I said there were a lot of mixed signals. Having a volatility index, the VIX, up here at 22 really bothers me. However, I do think a lot of the uncertainty could be related to the election. I'm going to be interested to see what the VIX does if the election, ends today, which we don't know for sure, but typically they end on election day. Anyway, if we get through the election today and the market is still, hovering not far from 52-week highs, all-time highs, then it'll be interesting to see what happens to the VIX over the next few days. I would suspect, again, that if it's up because of the election, once we get past the election, it should come back down. But there are a lot of folks arguing for many different things in terms of the VIX and why there's so much fear out there. So we'll let it all play out. What I can say is that when the VIX is over 20, you do need to be mindful of it. Sometimes just outright cautious. The only reason that I'm kind of giving it a little bit of leeway here at 21, almost 22, is that we've had two recent tops at 23, maybe just over 23. So if the VIX tops again at 23, anytime the VIX tops, you want to be in the stock market. I'm not going to say that works 100% of the time, but probably 99. So when the VIX is topping and that fear starts to drop, that is usually an excellent opportunity to be in on stocks on the long side, because the stock market usually goes up when the VIX goes down. So that's why the high VIX could be bullish. But if that VIX breaks up above 23 and our major indices drop below the 50-day moving average, I don't care what camp you're in, bullish, bearish, whatever, you've got to respect that breakdown with a rising VIX. So that's kind of, where we sit right now. And that's why, to me, it's a little bit confusing. We've had the 5-day moving average of the equity only put call ratio, which has been, telling us to be careful because it's been so complacent. Normally that marks tops. And if you look at the S&P 500, might as well take a look there. If you look at the S&P 500, we topped right here in mid-October, tried to go back up, and then topped again here just a few days ago. Let me just see if I can pull up the 5-day moving average down here. So let's pull up price, CPCE. And we'll do a simple moving average 5-day down here on the bottom. So here's your move up, and here is that CPCE, and this is the 5-day moving. Oh, I needed to do invisible. This is really making it hard to read. So let's do this. Okay, there we go. So essentially, when you get this 5-day moving average down here at around 0.5, what that's telling you, as opposed to like 0.75, is that you're trading many, many more calls versus puts. Puts are the denominator or the numerator, and the calls are the denominator. So it's puts divided by calls. So when the puts are going down relative to calls, when a lot more calls are being bought, that ratio between the two drops significantly. So if you've had, one put or two puts being bought for every 2 calls, then your ratio is going to be 1.0, which is very high reading for the equity only put call ratio. But let's say it drops to 1 put for every 2 calls being bought, then you've got 1 divided by 2, which is 0.50. And that's heavily skewed more toward the calls. And so this is a point right now, 5-day moving average is at 0.64, which is nice because we're getting a little bit of relief off these readings that we had seen down here about 0.55 or 0.525. And those 5-day readings down around that level historically have marked short-term tops in the stock market. So when you look at where we were back in mid-October at those low readings, it's not shocking that the market, finally found the top up near that, 5,900 level. So now we're starting to head back in the other way. Now, when you get to about 0.75 or above, that's when a lot of times we will bottom in the S&P 500. Look at this top right here, coinciding with this bottom. How about this top right here, coinciding with that bottom? How about this top, coinciding with that bottom? Here, actually, there were some unusual readings. I don't want to get into that, but there were hedge funds that were buying a lot of equity puts, which was spiking this number. But we want to know what individuals are doing. And it's very unusual. It's only been the last few years when we've seen hedge funds start buying equity puts in large quantities, and they've been skewing the actual relationship that we've been following. So I actually have an adjusted CPCE that I use, because whenever I see those spikes, and a lot of times you'll see them intraday, you'll just see a massive number of equity puts being bought over, say, an hour, 2 half-hour readings. And when you see that, that's not, especially if the market's not getting killed, that's not equity traders doing that. It's hedge funds that are hedging against some large positions that they own in stocks like Apple and Microsoft and some of the Mag 7 stocks heavily traded in the options world. Anyhow, that's a lot more detail than I wanted to give. But, right now we're moving back up into that neutral range. So that's good. We've pulled back. This reading down here doesn't mean we're starting a bear market. It just means that we've gone too far, too fast to the upside. It may coincide with other signals that suggest it could start a bear market. But this one by itself, I call it my speedboat sentiment indicator, because it just goes back and forth. Look, we went from crazy bullish here, we top, to crazy bearish here, and we bottom. So, it gave 2 completely polar opposite signals within 3 weeks. That's not a long-term signal. That's a short-term signal. So right now we got the S&P at the 50-day. We've unwound this sentiment indicator, which I think is a good thing. If there was any negative divergences, it was kind of hard to see whether we had a negative divergence. Well, now we've got the PPO at the center line. We've got price action at the 50-day. So that's been reset. Market's free to go wherever it wants to go. And so as a result, I think we just need to follow it. But, with us being in an uptrend, us being in a secular bull market, us being in the most bullish historical time of the year, I'm not betting bearishly. Now, I will bet cautiously, and I have no problems moving to the sideline if we break down and that VIX goes through 23. But until that happens, I'm just going to remain cautiously bullish. So here's that VIX chart that I was talking about. Here are your tops. Let's zero in here so you can see these. 20, right around that 23 level. Look at these tops coming in. Normally, again, historically, I've done a lot of research on this. This isn't my opinion. These are facts. When the when the VIX is above 20 and rising, it is the worst possible time to be in the stock market. So we were rising. We got up above 20. Market was pulling back, but we've been holding right here at this level. If we break out, we have a big hollow candle, and we go through 23 and a half, and we see that S&P 500 drop below the 50-day moving average. Short term, I'm not saying long term because I'm not expecting any kind of a bear market, but short term, you have to respect that as a trader, especially. Long-term investor, not really. I mean, I'm just not seeing other signals that suggest this is going to be a long-term thing. I mean, look what happened back at the beginning of August. I mean, we broke above 20, and literally a day or two later, we reached a high. Now, that's kind of unusual to go up into the 60s on the VIX within 2 days of a breakout. That was just crazy pessimism, fear, and we quickly topped. And when we topped, the S&P 500 just exploded. I mean, that was that August 5th high on the VIX. And from there, we started coming back down. If we go back to the S&P 500, we look at August 5th, that's when the bottom went in. So like I said, when the VIX tops, the problem is you don't know if the VIX is going to top at 25, 35, 45. But once you see it top and roll back over, the bottom's in. It's the way the VIX operates. All right, NASDAQ 100, taking a look there. You can see got up almost to the prior high from July, rolled back over. Like the S&P 500, though, it looked like we had a little negative divergence. Now we've worked our way back down below the 20-day for the first time in a couple months, month and a half, and we're sitting almost on the 50-day. So that's a good thing. I think, again, we're unwinding. AD lines pulled back a little bit, but at the recent high, we were at a 52-week high. So I think still Wall Street is supporting this move to the upside. We're a little overbought. I think we needed a little bit of a pullback based on sentiment indicators, and we've seen that. I wouldn't read too much more into that right now. It would be, I haven't done a specific study about the VIX in the fourth quarter, but I could say it would be very, very unusual for the VIX to explode higher in the month of November. In fact, we can do a seasonality. Let's do a seasonality of the VIX. I can tell you the market usually goes down August, September. So I would think the VIX is going to rise. The seasonality should show that the VIX rises during August, September. So let's do the seasonality. Zero in here. So over the last 5 years, look at September. The VIX has averaged going up 20 percentage points. Over the last 5 years, the VIX has averaged dropping 6.6% during the month of November. And if we go back, and actually look at this for the last 5 years, the VIX has dropped the most during the month of May, which means the market was going up really strongly in the month of May. So go away in May. That's another one of my favorites on Wall Street. That's when you hear somebody say go away in May, that's somebody who is listening to the media who has done no research on their own. That's my take when I hear somebody say go away in May. Anyway, during this entire secular bull market, look at the VIX. August, averages rising 14.7. September, 7.6. October, 5.1. November, minus 5.2. This is a little surprising. I mean, December's not a great month, but I wouldn't have expected the average VIX climb to be 7.8 and the VIX rising almost 3 out of every 4 years during the month of December. That's a little bit of a surprise there. But other than that, this is kind of playing out exactly as I would think. July is the second best month for the market. so minus 4.3. And remember, you look across here and there's a lot of months where we have these big gains in the VIX. It doesn't mean necessarily that those are horrible months. Remember, if the VIX makes one big move, it could go from 12 at the end of one month to 30 at the end of the next month. Well, that 12 to 30 is 150% increase. So if you're looking for average increases and you get 1 year out of 12 or one January out of the last 12 where we've seen a big drop in the market and a huge spike in the VIX, that's going to skew the average numbers because the VIX doesn't tend to go down same percent. You can go up on the VIX 150%, 300%, 500%. I mean, if you go from 10 or 12 to 50 or 60 within a month, which is a little unusual, but it's happened, that would be 500% increase or 400% increase. When you're going down, if the VIX is at 15, chances are it's not going to go down more than 2 or 3 points. So sometimes you just have to use some common sense in how these percentages come up. I think part of it is the percentage. I think the other part of it is how often the VIX goes up or down. So here the VIX goes up roughly 2 out of every 3 years in the month of August. So 2 out of every 3 Augusts tend to see the VIX spike and by a considerable amount. So that just kind of goes along with what we know historically. August is not a good month. July and the second half of July is not a good month or half month. And then, of course, September and into October can be rough as well. All right, IWM, small caps moving up. See this recent pullback? We've been holding right around this 217, 218 area. And then just below that would be what I would think is more critical short-term support around 215. I mean, if we lose that, I think we're back into either the early September low or even possibly that first week of August low. And that's, again, where if the market sells off like that, we're going to see a VIX that's moving up pretty strongly. Transports. So transports, one thing I don't like is the fact that it keeps trading up during the day and leaving these long tails to the upside and closing back down near the lows. And the way you can see that, even if you don't see it on the chart, doesn't catch your eye, the other way you'll see it is in the AD line. Because the AD, all it's looking at is where you close relative to your range for the day. So if you're closing below the midpoint of your trading range, then you're going to get a negative impact in terms of the AD line. The volume is your multiplier. So if you have a really ugly day, you finish on the low of the day and it's a big volume day, that is going to send the AD spiraling lower. And of course, the opposite, closing on the high, would send it moving much, much higher. But anyway, the transports right now, I mean, I love the fact that the transports are trending above the rising 20-day, which is above the 50-day. But I'll be honest, I don't like almost every one of these days seeing afternoon selling. I would much rather see afternoon buying. So that part of it needs to change. Technically, though, we are above the 20. We are in an uptrend. We are in a very, very bullish period for transports. If I pull up seasonality here, you will see that over the last 12 years in this secular bull market, no month has gone up more often for transports than November. 83% of the month. So probably like 10 out of the last 12 years. And then down here at the bottom gives you the average November return, which is 5.2, which if you look across is the strongest month of the year. So yeah, I mean, it just depends on what kind of bias really that you want to favor. I mean, if you do have biases in your trading, like you go into the market every day thinking it's bearish, or you go into the market every single day thinking it's bullish, and you don't have the ability to see the other side and the possibility of the other side, that's a confirmation bias. You're just looking for anything that supports your bias. So you got to be really careful about that. Some think I have it, and that's fine if that's what you think. I think if you go back to end of 2021 and throughout the first half 2022, you'll see what it looks like for me to be bearish. I was extremely bearish during those 6 months of 2022. I was bearish before it even started because of signals that I was getting. So I don't mind looking to either side. I mean, it does you no good to remain bullish in a bear market. I mean, all you're going to do is lose your money. So I have no interest in doing that. I want to try and look as objectively as I can at the market. But anyway, transports during this time of the year, pretty good. Now, one thing I'll mention, someone wrote into me and said, well, November's already started, so you need to drag it back. That is true. We're into the 5th day of November. So November of 2024 is now on the books, but we haven't had much. So what you can do is just drag this back one. So now you're looking at the 12 years. Now, remember, now you're going into 2012. So if you want to just look to 2013, then you grab this and pull it back one. Now you got 11 years, 2013 to 2023. And then this will avoid looking at what we have seen so far in November of 2024. Hopefully that makes sense for you. But you can see still very solid reading there. 5.7 instead of 5.4, because so far in this year we haven't really done, or 5.2. We haven't really done much, right? We just started the month. So that's why we're dropping from 5.7 to 5.2. It's really not fair because we still got another 26 days of, been through 4 days. So we got the balance of the 26 days of November. Anyway, just going through some little details there. If you do like the way we approach the market at Earnings Beats, if you go over to our website, earningsbeats.com, you can start your no-cost trial. I would suggest you really strongly consider doing this because we're going to have our portfolio draft in, what's today? It'll be just under 2 weeks from today. And by being a part of that, you will know which stocks that we put into each of our portfolios. And with the small caps and the mid caps doing better, if you go into our historical performance, I said once small caps and mid caps started performing better, we would see portfolios improve. I want you to look at what's going on so far this quarter with outperformance by small caps and mid caps. The model portfolio right now, this is through yesterday's close, up 6.97%. The S&P is up 1.86. So that's more than 5 percentage points higher. Look at the aggressive. This is where we do a lot of the small and mid cap stocks, up 14% versus the S&P's 1.86%. It's the best quarter we've had in this aggressive portfolio probably in 3 years, which also was about the last time that small caps were outperforming by any kind of significant measure. So makes perfect sense to me. But I believe small caps are going to continue to do well because of what I talked about earlier. The fact that short-term rates are coming down, long-term rates are going up. Nirvana for these stocks, for the small banks. And who are their customers? Small companies. You don't have Apple. Well, Apple doesn't borrow, but Apple doesn't use a small bank for its banking needs. Apple, the large companies, the behemoths, are going to use the JP Morgans of the world. The small companies are going to gravitate toward their local small cap banks or mid cap banks, regional banks. Those are the ones that are really the heart and soul of most companies in this country. And they're going to lend more easily going forward. And that's how small companies, mid-sized companies build their business. That's how they grow. They borrow, they invest, they grow. That has not been the environment we've been in for the last 3 years. So keep all of that in mind. I do want to just show you Sono. I mentioned this as an EB Digest. By the way, if you want to join our EB Digest, on our homepage, just scroll down, name, email address. That's all it takes. No credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. I do this for educational purposes. I do this to show how we trade, the things we look for, gaps, earnings. I trade probably earnings gaps more than anything. I love trading earnings gaps and earnings in general. But again, Monday and Wednesday that comes out. Make sure you go to the homepage, at least sign up for that and get the free newsletter. We have tens of thousands of people that are subscribers. That, again, no credit card, no commitment. End it if you want. But I think you're going to find that it's worthwhile. Anyway, now getting back to Sono, this was one of our EB Digest charts that we provided just a couple of weeks ago. We were down here around the 20-day moving average. I don't know exactly where we were. I don't know if we were at 12.5 or maybe it was just before that. But my point was I was seeing accumulation in the stock. Look at the AD line on this stock. It's been going down for months. Look at that AD line all of a sudden take off. Now we're starting to trend higher, and we got a breakout yesterday. So we're probably up 10% or close to 10% just since talking about it in our EB Digest. Probably 2 weeks ago. I don't think it was much further back than 2 weeks ago, certainly in the month of October. Anyway, just now getting the breakout. Look, the volume pick up, AD line soaring. And I had a member write in and say, well, yeah, they had so many customer service issues with their customers, and they really, screwed their customers. And I'm looking at the chart and I'm like, yeah, they probably did. I mean, look at the chart. Look at the weekly, the 5-year weekly chart. Look where they were back in 2021 when small caps were in favor. This was a $45 stock. Just recently, it was down close to 10. So I think they were punished for what happened in the past. What the charts are telling us is what we're looking at in the future. And when you look at what we see in the future, what I'm seeing is a stock that seems to be accumulated, that seems to be in the process of Wall Street accumulating it. We've just broken now above a key gap resistance level. I pointed out 1309 back when it was trading in the lower to mid 12s and said, we've got to get through 1309. That's the key resistance level. We were battling, couldn't get through. We had multiple tests. Yesterday, we got through. So anyway, this is just one example. We've had many of the way we try and teach to look for these different things, these bottoms, the tops, and so forth, and try and get in ahead of the crowd. Because I believe this stock's going back up to 19.5. I don't think it's going to happen this week. It could, but I don't think so. But I think over time, I wouldn't be surprised by the end of the year if it was a 19. But again, that was something we gave to our members back before we even had the breakout. Back when everyone was questioning, well, why would you get into this stock? Well, that's why. And now we're seeing the stock breaking out. Now, they do come up with earnings, I believe, in the next week or two. So check that out. That's going to be a very interesting report. I mean, we're getting a breakout ahead of it. We're starting to see a little bit more strength ahead of it. So it kind of leads me to think that maybe we're going to get a good report, but maybe this is all head fake. The AD line would kind of argue against a head fake. Some of the intraday trading that I reviewed and analyzed, I think also would lead me to believe that this is for real move, but earnings will give us the real deal. At this point, I wouldn't want to see this stock close below the 20-day moving average going forward. All right, last thing I want to do is just take a look. I know there was a lot of earnings came out overnight. Actually, we can just use a sharp chart. Palantir, another one of we've been on fire with many of these small, mid-sized companies, although Palantir is more of large cap. But this is in our model portfolio, and they reported earnings yesterday after the bell, and the stock is up 17%. So those numbers I showed you where the model portfolio and aggressive are killing the S&P 500, model portfolio is only going to get better with this huge positive reaction on Palantir today. All right, that's about it. Let's get a quick update, see where the market is right now. Well, we've seen everything turn green pretty good, much better than it was earlier. Small caps, though, seem to be lagging. Yesterday, they were leading. That kind of has gone back and forth. But since July, mid-July, small caps have outperformed the S&P and the NASDAQ by a wide margin. And I believe it's only going to expand going forward. Time will tell on that one. But everything is pretty much up. NASDAQ leading the charge, up almost 0.7%. NASDAQ 100 above that. It is election day. We see the VIX down today, down 3%. I'd really like to see the VIX go back down below 20 and then ultimately down below 17. And once those two things occur on the VIX, I believe we'll be in the process of setting new highs. And I do expect new highs in the fourth quarter. Anyhow, that's it for me. Have a great day, everybody. Happy trading.